Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. We have a lot to cover in this episode. Now, we think that we're in the last phase of a major bull run that we've had since 2009. We've had tremendous S&P 500 performance since that bottom after the great financial crisis. And as you would expect, towards the end of that run, as we see with most big top formations in the markets, we're starting to see speculative behavior appear. For example, the small trader call buying is at similar levels to what we saw at the height of the .com bubble. Now, of course, in each video, we take a look at different measures and different ways of proving that we're seeing signs of the cycle ending. But one of my favorite ways to represent it is just by looking at the 200-week moving average. This is a weekly chart of the S&P 500 going back to the 1980s, and I've put an indicator here telling you the difference between the price and the 200-week moving average. And you can see the price action that we've had post-COVID here and that breakout that we've made out of that bull market price channel. That has led to some pretty significant levels of overextension relative to that moving average, levels of overextension that we haven't seen since the .com bubble, since 1999, right here. So we're definitely in some type of a speculative environment coming towards the end of a big bull run here, but these can be potentially massively profitable if you know how to navigate them. And that's our objective here. We fully intend on navigating these markets successfully. If you want to do that with us, make sure to smash that subscribe button. Now, in this video, we're going to take a look at the recent price action over the past couple of weeks. Some very interesting stuff here, what we think is going to happen next on the markets, and then we're going to take a look at some bigger picture stuff, taking a look at long-term macro and how we can predict big tops in the markets. I hope you guys are going to enjoy this one. And now, without further ado, let's get right into it. All right, so jumping to a shorter term chart of the S&P 500 on this 8-hour chart here, that's the COVID crisis, big rally, extremely strong performance even throughout the last year. And then we've had this small correction here throughout September and the beginning of October. Now, if you've been watching our videos, you'll know that we expected a bottom to happen very, very quickly. And sure enough, it seems like that's what's happening right now. We're breaking out of this bearish structure that we've had in place and attempting to break back above these lines of support. Now, this is a tough line of resistance, so we'll see what happens right here. But just looking at the price action here on the daily chart now, it seems like the S&P 500 held that 100-day moving average. It's bouncing off of it very impulsively, and it's doing so with divergence on the RSI, right? And we haven't seen divergence on the RSI. I made a mistake last video. The last time we saw this, where the price goes down and the RSI goes up, which doesn't confirm the move down, is during COVID here. Right here at 2,450 points, we had that first divergence, and very shortly after that, we had a major market bounce. So that just shows you the massive opportunity this is right now. The VIX is coming down off resistance here. It rejected off that first resistance on the first move down, then second resistance, and now it's heading down. That's bullish. And the stock market breadth here is surging very rapidly on this recent move up. We'll see how this develops, but this is how you get major market rallies. If we put the S&P 500 on top of this chart, you can see a big surge in the market breadth is an incredibly bullish development. Every major stock market rally is accompanied with a rise in the breadth. We saw that right after COVID here, right after this bottom in 2018, big surge in the stock market breadth. So seeing this is a big bullish development yet again. And yet it seems that unfortunately, everyone was on the wrong side of that trade. Very few people were expecting a bounce here. This is a sentiment indicator that we love to use, the advisor and investor model, and it actually takes into account a large amount of different investor surveys and what their combined readings are. And you can see here as we were correcting right there, look at where the sentiment on this model was. It was at extreme fear. We hadn't seen this much fear since the COVID-19 crisis. Why is that important? Because if you remember what Warren Buffett said, buy when others are fearful, and that's exactly what we've been doing. Every major bottom in this indicator corresponds to major bottoms in the stock market. These two big fear readings were in 2015 and 2016, two big corrections right here. Big bottom in 2018, followed by a large run here. Then again at the bottom of the repo crisis, a big fear reading, then COVID, and then now, right? That's how crazy that is. We're seeing the same level of investor fear to what we saw during a pandemic with global shutdowns. Nothing is happening right now. Economic indicators are pointing up. We're not seeing signs of a slowdown like we typically see before major recessions. And one more very interesting metric that I want to show you guys is the inverse ETF volume. Inverse ETFs track the S&P 500 in reverse, right? That's what it means. And so when you're buying an inverse ETF, you're basically betting that the stock market is going to go down. And that's a really interesting indicator to use because it's a great contrarian indicator. When a lot of retail traders are betting that the stock market is going to go down, that's typically when you want to be buying, right? And so recently we've seen this inverse ETF volume surge. Last time that happened was on this big bottom here. Before that, it was on this big bottom right here. And just every major bottom over the last year and a half has been timed with this inverse ETF volume. It's crazy how well it works. If you like the data, the research, and the effort that goes into making these videos, make sure to smash that like button and also consider subscribing to our service at gameoftrades.net. There's a 1-week free trial if you want to test out our service and see what kind of things we post, because we've really managed to keep our members on the right side of this trade, at least what we believe is to be the right side of this trade. And believe me, I know how hard it is to keep your head straight in this market. You go on YouTube, you go on Twitter, everyone is bearish, everyone's looking for downside, everyone's trying to be smarter than the system, but failing miserably. So it can be very difficult if you're alone, if you're a retail trader. It can be very difficult to stay confident in your calls. I think that's probably the part of our service that our members love the most. So not only do we provide our convictions and our forecasts and exactly the reasons why, but we help you keep a calm, reasonable, and objective approach to the markets by looking at these types of indicators. When there's a lot of fear in the markets, it's not a moment to be panicking. And I think a lot of investors, a lot of new investors and new traders make the mistake of giving in to all the bearish information that's flowing around on the internet, and eventually their emotions take the better of them and they panic sell at the bottom of the move. That's when you get the big S&P 500 breakout. So make sure to try out our service if you want to be part of our community and take advantage of all this information, take advantage of our research, our forecasts, and hopefully staying on the right side of these trades. Now, what does this actually mean, right? Because there is a reason why we're paying attention to it other than actually timing market bottoms. Why do sentiment indicators like this actually work? And I think using the inverse ETF volume is a great way to illustrate why these contrarian indicators work. Because when you have an inverse ETF, it's often a leveraged ETF. These are not ETFs that you can hold for a significant amount of time. And so if the market starts to rally, if it starts to go the other way, all these retail traders that bought these ETFs are going to have to sell. And when they sell their ETF, that's the equivalent of them buying the S&P 500, and they actually end up pushing the price up. And that's why contrarian indicators are so powerful, because when there's lots of fear, it means many people are shorting or are staying on the side with a lot of cash. And when the market starts to look a little bit more bullish, maybe there's a little bit of Good news here. Where do you think all that cash goes? It goes back into the market and pushes it even higher. And that can create FOMO type of moves. We saw many of those throughout the last year and a half. It's very possible that the recent bearish reading we saw here eventually leads to a FOMO type of move. Now, I want to show you quite an incredible chart throughout the rest of this video, and hopefully this is going to make it easier for you to visualize when the S&P 500 is actually going to top. Because that's the question that's on everyone's mind. Yes, Peter, it's great that you're bullish. It's great that you're staying bullish at the right moment, but when are we actually going to top? Now, other than the fact that at tops, you typically want to see broad bullish sentiment, which is not what we saw right here. We already saw a lot of fear at this top. I expect the top of the bull run to have euphoric type of sentiment. And that can happen very, very quickly, believe me. But that's not what I want to talk about. What I want to talk about is the relationship between the S&P 500 and the 10-year yield. And I'm just going to add the 10-year yield on this chart just so that you get an idea. We've had yields go down throughout the last 25 years here. That's very clear. And as yields have been going down, stock market valuations have been going up. So over the long term, we've seen one go up and one go down. But over the short term, we see both of them rally together. We see yields rally, you see the stock market rally, you see yields go down, you see the stock market go down. And again and again and again, rinse, wash, repeat. That's how it works. Now, what we also know is that the higher the yield is, the more that's going to put pressure on the stock market. So when you see a big rally in yields, you typically see the stock market rally with it, but eventually those higher yields are going to put pressure on the stock market. And so the chart I want to show you is not this, but we're going to combine the two to give us an indicator of under or overvaluation. And I want to do this by multiplying the S&P 500 by the 10-year yield. And that gives you this magnificent trading range with a clear top and a clear bottom. And so that makes sense, right? You have stocks go up over time, yields go down over time. When you multiply them together, you have a constant. But as we discussed, in the short term, they rally together and they go down together. Rally together, go down together. And so that's the trading range that we're seeing. And let me walk you through that. As we saw the dot-com bubble rise here during the late 1990s, we saw a rally in the stock market and we saw a rally in yields. And so the fact that both of them were rallying pushed this indicator up to very, very high valuations. Now let's take the example of the great financial crisis. We saw stocks move down and yields move down at the same time, and that brought this indicator down to extreme lows. So if you had actually used this indicator to time tops and bottoms, you would have sold at the height of the dot-com bubble. You would have bought at the bottom of the great financial crisis. You would have sold right here at the top of this 10-year bull run, and you would have bought here right after the COVID shock. Now, the point that I wanted to highlight with this indicator is that we're actually nowhere close to any of these big tops that we've previously seen. So if you actually put the S&P 500 in proportion to the 10-year yield, we could still have some upside left in both yields and the stock market before we make a big top. And guess what's happening? We're seeing stocks rally and we've seen yields rally as expected. So zooming out of this 20-year chart of government bond yields, we can reasonably expect the 10-year yield to rally into this zone of resistance. Every big market top has occurred when yields tagged that line of resistance. That's 1999, that's 2007, that's 2018 before the repo crisis and COVID. And so I believe the next big top in the markets could happen very, very quickly at the beginning of 2022 if we see a rally in yields reach those levels. So I hope you guys enjoyed this video. If you did, make sure to leave us a like down below. Now, in the meantime, I wish you good luck on your trading and see you next time.